Every empire in history has believed the same comforting lie, that its money would last forever. Rome believed it. Revolutionary France believed it. Modern banks still believe it today. And every single time, history proves them wrong. Because the truth is brutal. Financial collapse is not rare. It's the default ending. Across centuries and continents, entire economies have disintegrated almost overnight. Savings vanished. Salaries became meaningless. And millions of ordinary people woke up to discover their wealth had simply evaporated. But the most important lesson from these disasters isn't that collapse happens. It's that the same pattern repeats every time. And the people who survive it are almost never the ones who trusted the system the most. They're the ones who question it first. Take the Byzantine Empire as an example. For centuries, its gold coin called the solidus was one of the most trusted currencies on Earth. Merchants across Europe, Asia, and the Middle East accepted it without hesitation. It was so reliable that it effectively became the world's reserve currency of the medieval era. But eventually something familiar happened. The government began quietly reducing the purity of the coin. Less gold, more cheap metals mixed inside. At first, nobody noticed. Then confidence started to crack. And once trust disappeared, the entire monetary system weakened. A currency that had dominated global trade for centuries slowly lost credibility. The merchants who survived this transition weren't the ones holding official coins. They were the ones quietly storing real gold and land outside the reach of the empire. That pattern appears again and again throughout history. Sometimes the collapse is caused by governments manipulating money. Other times it comes from sudden shocks. One of the most dramatic examples was the Black Death in the 1300s. The plague killed nearly half of Europe's population. Entire towns disappeared. Trade routes collapsed. Economies froze. But something strange happened after the catastrophe. Labor suddenly became incredibly valuable. With fewer workers alive, survivors could demand higher wages. Land that once cost fortunes could be purchased cheaply because there were simply not enough people left to work it. Those who had liquidity or resources suddenly found themselves in an extraordinary position. Property, farmland, and homes could be acquired at fractions of their former price. If this sounds familiar, it should. During the COVID pandemic, governments printed trillions of dollars to keep economies running. Supply chains broke. Markets panicked. And then something remarkable happened. Asset prices exploded. Stocks surged. Housing prices soared. Wealth inequality widened dramatically. Those with cash bought assets. Those living paycheck to paycheck fell further behind. The pattern from medieval Europe repeated itself almost perfectly. Crises don't just destroy wealth. They redistribute it. But perhaps the most dangerous illusion in finance is the belief that powerful institutions will protect you. History shows the opposite. In the 1300s, the city of Florence was the financial center of Europe. Massive banking dynasties dominated international lending. Families like the Bardi and the Peruzzi were considered untouchable. Then one borrower defaulted. The King of England stopped paying his loans. And suddenly the most powerful banks in Europe collapsed like dominoes. Depositors were wiped out. Trade froze. And citizens who had trusted the great banking houses discovered something terrifying. Too big to fail is a myth that appears in every era. It existed in medieval Italy. It existed in 2008 with global banks. And it existed in Lebanon as recently as 2019. When Lebanon's financial system collapsed, banks froze withdrawals almost overnight. Citizens couldn't access their own savings. The national currency lost over 90% of its value. Doctors, engineers, retirees, people who had trusted the banking system their entire lives, watched their wealth vanish. Meanwhile, those who had diversified abroad, held foreign currency, or owned tangible assets survived far better. And that is the pattern history reveals over and over again. When systems fail, promises collapse first. Paper money can be printed. Debt can explode. Institutions can break. But certain forms of value tend to survive. Land, gold, productive businesses, food, skills. In every crisis, The people who rise are not simply the ones who own assets. They are the ones who can still create value when others cannot. The baker who can still make bread. The farmer who can grow food. The builder who can repair homes. The trader who can move goods between places. When money stops working, production still matters. And those who provide real value rarely remain poor for long. This leads to one final, uncomfortable truth about financial collapse. For many people, it is devastation. But for a small minority who are prepared, it becomes opportunity. After the Black Death, peasants became landowners. After the 2008 housing crash, investors bought homes at massive discounts. In every crisis, wealth moves. From the unprepared to the prepared. From paper promises to real assets. From passive savers to active builders. History has shown this transfer again and again for over 2,000 years. So the real question isn't whether financial systems eventually fail. They always do. The real question is whether you'll be one of the many left holding promises, or one of the few holding something real. Because history doesn't repeat perfectly. But if you ignore its warnings, it has a habit of crushing you anyway.